Tēnā koutou katoa, greetings everyone, and thank you for that lovely introduction, Tony. Thanks to all of you for coming, and thank you, Sharesies, for making this space available. You are exactly the sort of business New Zealand needs more of to create opportunities for the next generation. Sharesies was started by smart people who identified a gap in the market, harnessed technology, and went about changing the way in which New Zealanders invest. In just a few years, you've grown from a tiny operation employing a handful of people to a business worth more than $500 million, employing more than 200 people and expanding its reach to Australia. Hopefully, over time, you'll go further. That's a good news story for the people who work here, for the communities your incomes support, for the customers you serve, and for our economy as a whole. Sharesies is also an inspiration to other Kiwi entrepreneurs, including many in New Zealand's booming fintech sector, which grew more than 20% in the past year. I want to see more successes like this in New Zealand, and that's why I'm here today. When New Zealand entrepreneurs and startups do well, they create more and better paying jobs, more tax revenue to support government services, and more opportunities for us all. That mission, driving economic growth and creating the conditions for business success, is at the heart of this government's budget. Let me be clear, I don't want growth just for growth's sake. It's much more than numbers on a chart for me. I want growth so that our kids and future New Zealanders can enjoy the better choices, opportunities and standard of living we all aspire to, and that too many Kiwis are missing out on today. On Thursday next week, I'll set out the full details of our budget. Just 9 sleeps to go. It will detail the government's specific spending and revenue choices, key new infrastructure investments, the path for borrowing and debt, and our plans for strengthening the fundamentals of the New Zealand economy. I'm looking forward to delivering it. In a recent speech, I detailed the difficult context in which the government is delivering this year's budget. New Zealand has gone through a very tough few years of high inflation, high interest rates, and little to no real growth. The government has been running big deficits and accumulating debt. And just as our economic recovery has gotten underway, global events have conspired to make things harder. That's just reality. We can't wish it away, but nor should we use it as an excuse to shy away from making choices now that will set New Zealand up better for the longer term. Today, I want to talk a bit more about that longer term picture and detail one specific budget initiative that shows the government's commitment to sustained and long-term growth. Because budgets must not just be about the short term, the who is getting what. Yes, there are a number of initiatives in the budget designed to address the immediate issues of the here and now. And yes, I am acutely conscious of the cost of living challenges many Kiwis are facing today and the hard yards so many people have gone through over these past few years. It's essential that our budget sustains the government services and supports that they rely on, even though money is tighter than ever. So our budget is built on a series of careful choices to ensure that that is possible, that we provide the funding needed for health, education, other vital public services and essential social supports. But as a responsible government, we also need to be thinking ahead and addressing the structural challenges confronting our country. Our budget also takes careful steps to do that, and that's what I want to speak a bit more about today. There are 3 long-term challenges for New Zealand that I spend a lot of time thinking about. They are productivity, social mobility, and the ageing of the population. These are issues we need to be awake to now, lest we make life much harder for the people who follow us. So let me make a few remarks about each of these challenges. I'll start with productivity. Productivity is a key indicator of economic performance. The most common measure of productivity is labour productivity, which measures output per unit of time worked. In New Zealand, labour productivity has averaged just 0.3% a year over the past 10 years. That's low by historic standards and low in comparison with our international peers. Don't get me wrong, there's no doubt Kiwis work very hard. And in fact, we work relatively big hours. Our challenge historically has been that we just don't generate as much for that effort as those in some other countries. Our labour productivity levels rank near the bottom of OECD countries, well behind those in Australia, Canada, the United States, and the United Kingdom. This rankles me, not just because I'm competitive by nature, but because I think New Zealand has so much intrinsically going for it when compared to that list of other countries. So New Zealand can and must do better in the productivity race. Why does low productivity matter? Because productivity determines how competitive our businesses are. The more competitive businesses are, the more people they can hire and the more money they can pay in salaries and wages. And that in turn determines how fast our country can grow and the revenue we have available for investing in the things that matter, like cancer drugs, education programs, hospitals and police. So what are the causes of New Zealand's low productivity rates? Treasury identifies three key problems. First is low capital intensity. That is the machinery, tools and technology available per worker. More capital per worker typically means higher productivity and higher wages. The increase in New Zealand's capital intensity has slowed over time, from 1.9% per year between 1997 and 2008 to 0.7% between 2012 and 2023. Basically, our workers have less access to the machinery, innovation and technology that would allow them to be more productive. And our budget will take steps to address that. The second underlying driver of low productivity is low rates of foreign direct investment. This restricts the access that Kiwi businesses have to the capital they need to grow and the world-leading know-how they need to thrive. It slows uptake of innovation and best practices. And our budget will take steps to address those issues too. Third issue in terms of productivity is export intensity. By international standards, relatively few New Zealand businesses derive large portions of their income from exports. This reduces the scale of New Zealand businesses, competition and opportunities to learn. The good news is, despite all the global shenanigans playing out, New Zealand is in the midst of an export-led economic recovery. Dairy farmers, horticulturalists, meat producers, all are doing well. In recent years, New Zealand entrepreneurs have broken new ground in fields like space, film and accounting software, driving our exporters. And our government is ambitious to build on this export success, with a stretch goal of doubling New Zealand's exports by 2030. Our budget will take further steps to drive that work forward. You know, the thing with all these underlying productivity challenges is that there is no quick fix or easy road to success. It's about doing lots of things well, over successive budgets, keeping our eyes on the big prize while we deal with the here and now. Budget initiatives in this area won't make your household budget bigger today, but over time they are essential to growing the household budgets New Zealanders will have in future. The next big challenge I want to talk about is social mobility. It's a very Kiwi concept. The idea that no matter what background you come from, ours should be a country where with hard work and good choices, you can have the opportunity to succeed. And of course, that's why our government is putting so much emphasis on improving educational achievement in our schools. Getting back to the basics of reading, writing and maths, and financial literacy too, which I know Sharesies are fans of. Those skills are tickets to the game of life. We owe it to each and every Kiwi kid to make sure they leave school with those critical skills. A desire to improve social mobility is also why our government is revitalising the social investment approach developed by my predecessor, Bill English. Successive governments have spent huge sums trying to tackle the entrenched disadvantage that blights lives, pushes up costs for other New Zealanders, and fuels criminal offending. In addition to core social supports in our schools and our health services and elsewhere, government agencies collectively spend around $7 billion per year buying social services designed to deliver better lives for those with particularly challenging problems. However, despite the best intentions of all involved, this expenditure can't be described as a success. There are some fantastic examples of lives being turned around, but the overall picture is grim. Too many Kiwis remain trapped in cycles of intergenerational disadvantage. We are spending more on ambulances at the bottom of the cliff than fences at the top. Data now gives us a very good idea of those at greatest risk. We also know that intervening early increases the prospects of success. There are some incredible community and iwi organisations who know what to do, but too often they have been held back by the frustrations of government bureaucracy and short-termism. We can do much better here. Shifting a young New Zealander off a life of welfare dependency and potential criminal offending greatly reduces future costs for everyone else. But most importantly, it gives that New Zealander a chance to lead a fulfilling, productive life. And I know we want that for all our kids. So later this week, I'll announce an initiative in this year's budget that is designed to do just that and drive social investment forward. The third big challenge I think about is demographic change, more specifically, the ageing of our population. Kiwis are living longer, and this is something to celebrate, but it also has an economic consequence as we seek to ensure people have the income and financial security they need in retirement. There's two things I think about here. One is KiwiSaver, and the other is government superannuation. Let me make a few comments about each. I'm delighted to see how many Kiwis are embracing KiwiSaver as a way of saving for a first home and to supplement their income in retirement. KiwiSaver membership is high, with more than 3 million members, representing around 96% of the working age population. Fund balances differ, but most working Kiwis choose to make regular contributions to their KiwiSaver funds, matched by contributions from their employers. KiwiSaver has become an increasingly important tool for people choosing to buy a first home, with around 42,000 people using their KiwiSaver funds for this purpose in the past year. It's also an increasingly important supplement to support people's incomes in retirement. The other good news story here is that the Reserve Bank estimates around 40% of all KiwiSaver balances are invested in New Zealand-based financial products and assets. I want to acknowledge the work Sharesies has done to promote KiwiSaver uptake and your efforts to improve Kiwis' understandings of how it can support their financial security. I share your mission. I want to see KiwiSaver balances continue to grow, and our budget will contain steps to support that mission. Let me now turn to New Zealand's superannuation. In the year 2000, there were around 6.5 people of working age, that's 15 and over, for every superannuitant. Today, there are about 4.7 people of working age for every superannuitant, a lot fewer working people supporting those in retirement. By 2050, there are expected to be only about 3.6 people of working age for every superannuitant. At the same time, superannuation costs are increasing, both in dollar terms and as a proportion of our economy. Gross expenditure on superannuation in 2000 was $5.1 billion, or 4.4% of GDP. By 2050, it's expected to be $71.7 billion, or 6.5% of GDP. This leaping cost will play out in this year's budget. New Zealand's superannuation costs will rise from $23.2 billion this year to $29 billion in 2029. Put this together with the cost of healthcare, which increases every year, and it's clear New Zealand needs to be earning more as a country to support this growing cost. In the coming years, increasing superannuation costs will be partially offset by withdrawals from the Superannuation Fund, which was established to help smooth superannuation costs between generations. We are now approaching the time when the super fund is big enough to ensure that withdrawals, rather than contributions, are the normal outcome each year. This is not a government decision, let me be clear. It is driven by a formula in the relevant Act. And something of a milestone event, the first withdrawal from the New Zealand Super Fund is forecast to happen in 2028, a very modest withdrawal of $32 million. In the short term, there will be some bouncing around between withdrawals and contributions as the formula is applied. But from 2031 onwards, projections show that withdrawals from the super fund are expected in every year. Withdrawals help cover the costs of superannuation, so taxpayers don't face the full cost each year. This doesn't mean the super fund will get smaller, far from it. The fund currently has $80 billion worth of investments, and on reasonable assumptions, the super fund returns will outstrip withdrawals and the fund will continue to get bigger every year. And that brings me to the announcement I want to make today. As part of its investment activity, the New Zealand Super Fund has invested $300 million in a venture capital fund called Elevate. The fund was established in 2020 to support high-growth, tech-based startups in New Zealand. The fund was created to fill a funding gap at the so-called Series A-B stage of startup funding, the point at which startups typically need $2 to $20 million to scale beyond their early seed funding. The Elevate Fund operates as a fund of funds. That is, it invests not directly in startups, but in private venture capital funds which must also attract private co-investment. In doing so, it supports the commercialisation of science and technology and helps export-focused startups to attract global investment. It also helps to attract global investment to New Zealand by showing those investors that there's a pipeline of companies reaching the Series C stage. The short-term goal of Elevate is to increase startup funding and get more great Kiwi startups away and racing. The long-term goal is to help build a self-sustaining venture capital market in New Zealand in which returns from previous investments fund future investments. The results from Elevate's first 5 years of operation are positive. It has committed $221 million across 9 funds and attracted $536 million of private capital, a ratio of $2.4 of private equity for every dollar committed by the fund. This has led to $440 million being invested in 123 startups across sectors like software, clean tech and medtech. There have been some significant successes, and I'll give you a couple of examples. First, Dawn Aerospace, which is developing reusable space planes and non-toxic satellite propulsion systems to make space access more sustainable and more affordable. In 2022, the Elevate Fund helped close a $22 million funding raise for Dawn with a number of local venture capital funds. This was instrumental in bridging the gap to a larger fundraising round of around $100 million. Since then, Dawn Aerospace has expanded operations to France and established a European facility in the Netherlands, all while still being run out of Christchurch. 26 satellites, 122 thrusters, and 3 launches later, Dawn Aerospace is at the cutting edge of its sector with an ever-growing global presence and domestic economic impact. Second example, Halter, which has created a small smart collar for cows that uses GPS, sound and vibration to guide livestock, allowing farmers to manage grazing, shifting and monitoring all from their phone. The collar is transforming day-to-day farm operations. And with the help of Elevate-backed funds, Halter raised $32 million in a Series B funding round in 2021. In the time since, Halter has tripled its workforce to meet growing demands in markets including Australia and the United States. It has since attracted further Series C fundraising and is continuing with its plans to revolutionise farming. In time, the Elevate Fund behind these ventures is expected to become self-sustaining, with the returns from previous investments funding future investments. However, the fund is not yet self-sustaining. Therefore, I'm announcing today that the government is committing an extra $100 million to the Elevate Venture Capital Fund at Budget 2025, unleashing a new generation of startup businesses in New Zealand. This will be funded through a combination of the 2025 contribution to the New Zealand Super Fund of $61 million per the formula, topped up with an additional $39 million from the Budget 25 capital allowance. This follows the approach taken by the previous government when the Elevate Fund was established. The initial government contribution to Elevate was funded from the Crown's contribution to the Super Fund. The government wants to see more companies like Sharesies, Halter and Dawn Aerospace capitalise on New Zealand talent and grow from small beginnings to create opportunities for other New Zealanders and contribute to the New Zealand economy. Let me finish on an optimistic note. The international order is undoubtedly undergoing profound change. We are seeing a shift from rules to power, from economics to security, and from efficiency to resiliency. And of course, on one level, none of this is good news for a small, remote nation that relies on trade for prosperity. But New Zealand is blessed with abundant natural resources, safe, secure borders, strong institutions, a constellation of strong trading relationships, and decent, smart, resilient people. Our best years are ahead of us. The job of government is to unlock that potential for New Zealanders today and for New Zealanders in the years ahead. And next week's budget will be the next step in that process. Thank you for listening. I understand we have time for a few questions from the audience, if you have any, and later questions from the media. But because the media is here, it seems unlikely that there are going to be a brave first hand. Well, perhaps what we can do, if there are no questions, is I can go and take questions with the media and then circulate and have a chat with some of you who might want to ask your questions privately, unless anyone's had a moment to reflect and has one. No? Turns out not everyone's as brave in front of TVNZ as I have to be. Okay. Thanks very much. Good morning. Before I kick off and take a few of your questions, I just wanted to make a few remarks about Chris Hipkins' comments today. In his speech, he confirmed that Labor is going to double down on their failed strategy of borrow more, spend more, tax more, and hope it all works out. Well, New Zealand tried that over the past few years, and it led to record high inflation, significant levels of debt, and a cost of living crisis for New Zealanders. Now is not the time to go back to that failed economic approach. He also made a couple of comments which I think revealed his significant financial illiteracy. The first was that he pointed to nominal GDP growth on a per-person basis as a sign of Labor's success. Well, by that measure, Zimbabwe is a roaring success, because what Mr Hipkins seems to have forgotten is that that nominal growth was accompanied by record levels of inflation. And all New Zealanders understand that if inflation is eroding the real value of your pay packet, then its nominal value doesn't matter very much. And in recent years, what we saw was that prices rose a lot faster than incomes, and many New Zealanders were going backwards. So for Chris Hipkins to claim that was a roaring success shows he's either economically ignorant or prepared to take New Zealanders for fools. The second point he made, which was also factually incorrect, was to claim that New Zealand's debt levels now are similar to what they were after the global financial crisis and the Christchurch earthquakes. This is wrong. Debt at that time rose to around 25% of our GDP. It's now approaching 45%. So for Mr Hipkins to claim that debt is at similar levels to what it was then is wrong again. And in fact, the Treasury and others are clear that New Zealand is now approaching its debt ceiling, which is to say that if a significant event were to happen, be it an earthquake, a significant climatic event, an outbreak of disease, then New Zealand having to borrow more would be in a position where it could become very challenging to pay that money back, and we could enter an interest rate and debt spiral. Mr Hipkins is saying to you that his policy is borrow and hope. Borrow and hope that there won't be a rainy day. That's irresponsible, and New Zealand needs a government that will be responsible in the way it manages its economy and finances, and we're proud to be that government. Thank you.
Just on what you were saying about the amount of money, I think it was 300 million you were taking out of the super fund. I wasn't aware that the government...
No, that's the wrong figure.
Oh, well, how much was it?
63 million is the contribution that, by the formula, we need to make to the KiwiSaver Fund this year, and we are going to put that into the Elevate Fund.
I was talking about the second part, or the second part of the speech. You were saying it was $300 million.
It's a little less than that,
okay.
And it's not till 2028. And the money in that year is derived from the fund calculations in the Act, and I've set out the exact figure in the speech.
Okay, so you're not taking money out of the super fund per se to do that?
So the super fund is governed by a formula set out in law, which the government is sticking to, and that judges that in that year we will make a small withdrawal from the fund. It's less than the 300 million you've stated.
Nicola Willis, this is the announcement of the investment in Elevate, obviously, is an investment in a fund that co-invests with other funds. I mean, is this a sort of model, thinking with your economic growth hat on, the government is looking to pursue a bit more?
Absolutely, because we know that the government can give other investors confidence that these investments are worth making. When we've got private sector players at the table saying we want to put our money there, it's a real sign that these are investments with commercial prospects. And Elevate has demonstrated success in crowding an investment, both in a New Zealand sense, but also from international investors who see it investing, and that gives them confidence about the future. The message we want to send is be confident in New Zealand's pipeline of new entrepreneurs, new startups. We, the government, are so confident in their growth prospects that we're prepared to invest in them, and we encourage others to do so.
But given that, so why not
Sorry?
more? I mean, 100 million seems fairly small.
Well, the Elevate Fund still has residual funds left to invest, and I'm advised that with this level of top-up, they'll have a lot more options for how they invest in the next few years. Success can beget success. We will continue to evaluate whether more capital should be put into the Elevate Fund, but at this point we think it's the right number. I'm doubtful there will be a single initiative in the budget where someone will say, look, Minister, you've put in too much money, or look, Minister, that's exactly the right amount. It's always the case that people will argue for more. We think this is the right balance.
What portion of that investment, of the investment in the Elevate Fund fund is coming from the super fund.
It's not coming out of the super fund. So just to be clear, we make contributions to the super fund. And what the last government did when it created Elevate was it diverted its contribution from the super fund into the Elevate Fund, which is then governed by a structure underneath the New Zealand Superannuation Fund as part of its portfolio. We're taking the same approach, but we're also topping it up with our own capital allowance.
Super fund's independence, and what sort of advice did the Treasury and the super fund give you about diverting that investment?
It's a choice that's available to us to make because it does still sit within the Superannuation Fund's group of investments, but it requires a specific decision by Cabinet.
And on the 2028 withdrawal, I think the BFU last year had the first withdrawal in 2033. What has changed in the economy to mean that the formula is spitting out a withdrawal much earlier?
Look, it bounces around, and I want to emphasise that is a forecast. So what actually eventuates could bounce around over the following updates and the following years. Essentially, it relates to what's happening with GDP, demographics, the costs of New Zealand superannuation, the growth and the value in the super fund assets. It is a complicated formula. I think the point that I want New Zealanders to be aware of is many of us have heard for many years that at a certain point New Zealand superannuation costs will become so large that we will have to call on other funds to fund them. We're now at that point.
Are you ruling out cutting government contributions to KiwiSave as part of the budget?
I'm not ruling anything in or out at this stage. There's just 9 sleeps to go.
If it bounces around so much, how can you be sure that 2028 is the year? I mean, in terms of the size of the super fund, 32 million. It's kind of wafer thin.
Yeah, look, it is just a forecast.
So it might go eventuate.
That's correct. So what I'm simply sharing is based on Treasury's forecasts in this budget. That is the year they're expecting it to happen. It could bounce around. It's also of note that the contributions we'll be making to the super fund per the formula are going to be a lot smaller in the next few years than they have been in recent years.
GDP growth is lagging because the formula is so dependent on
Look, there's a number of factors, and I'm happy to connect you with the correct analyst at Treasury to take you through them. It wouldn't be right to just lean it on one factor. There's a number of differentials which interact with each other.
Can I just get it clear? So this year, 2025, the New Zealand Super Fund will invest 300 million into Elevate?
So there is already 300 million in Elevate, which the super fund, those
so
assets.
This brings me to the announcement I want to make today. The New Zealand Super Fund has invested 300 million.
Yes, that's what it has so far. I'm sorry if that's not clear. What we've announced today,
That's not a new announcement.
so the new announcement we're making today is an additional 100 million on top of that 300 million.
When was that 300 million invested?
That was in 2020.
And that money all comes
2019.
from diversions that were already going into the
So that was 300 million that was earmarked for the super fund, and the decision was to put it in the specific Elevate fund, which sits under the super fund. And what I'm announcing today is we're taking a similar approach to what was taken then, and we are providing another top up to the Elevate fund, 100 million. But because there are lower contributions going to the super fund, we're using some of the super fund contribution and some capital allowance from our budget.
What do you say to people who will look at that 61 million from the super fund?
It's not from the super
Yeah,
fund.
but it's your contribution. We can read out.
It's not. I'd say this is exactly what the last government did, and these funds will be managed as part of the super fund to deliver returns over the longer run.
But what do you say to people who might suggest you've rated the budget of women, now you're rating the budget of elderly?
I'd say they're wrong, and I would say that in fact what we are doing is ensuring that the super fund is sustainable and that New Zealand's superannuation is sustainable. Governments who pretend that they can just keep spending more and borrowing more with no consequence are the real ones who are stealing from New Zealanders' retirement savings.
How confident are you, because you said in your speech, on reasonable assumptions returns will outstrip withdrawals from the super fund? You've brought those withdrawals forward.
No, I haven't brought those withdrawals forward. Mikey, I'm sorry, but you're wrong. We have not brought those withdrawals forward. There is a formula set out in law introduced by Labor and endorsed by National, which sets out a formula for when and how large contributions to the super fund are and when and how large withdrawals from the super fund are. And what I am simply sharing with New Zealanders is that as a consequence of that formula, we are now approaching the point where Treasury forecasts we will make withdrawals. What we're also doing is continuing the same level of contributions under the superannuation formula that the law requires, and what we are also doing is endorsing the approach of the previous government and directing that some of those funds shouldn't just go into the super fund as a whole, but should go directly into start-up businesses, venture capital businesses that have the potential to grow our economy.
How confident are you that we won't be draining the super fund and we'll be able to manage, the returns won't outstrip the withdrawals?
I'm confident because that's the way that the fund has been set up in law, and we're sticking to the law as it currently is, which is designed to ensure that that fund continues to grow over the medium term and is in a position to support the payment of superannuation to New Zealanders. We're not changing anything with any of that. What I'm simply reflecting today is that we're now at the approach that politicians imagined some decades ago when we would need that super fund in order to support New Zealand superannuation. That day is here. It's a result of the formula that's in the Act, and it indicates to you that we are now at that point where the ageing population is such that taxpayers alone are not enough to fund those superannuation costs.
Just on the formula itself, when did this calculation that necessitated 2028, was that as recent as this morning? Was it a couple of weeks ago, a couple of months ago?
That formula is done in the lead up to every budget, and it was and that information was conveyed to me a few weeks ago.
So it's quite current. So it takes into effect issues that you called them global shenanigans, which I thought was an underplay of sorts. But anyway, that sort of global shenanigans, it takes all that to account? Yes,
but it's based on Treasury's up-to-date economic and fiscal forecasts. Obviously, there's always a close-off date for those, which I've reflected in previous speeches, but it's based on their assessment once those forecasts were finalised.
And what impact is the US-China tariffs likely to have here in New Zealand?
Sorry, I'll have to ask you again.
What impact is the China-US tariffs likely to have here in New Zealand?
Well, a couple of impacts. First of all, it is likely by the predictions of many economists that both those economies will grow slower as a result of those tariffs, and that could mean less demand for New Zealand's exports. On the other hand, I've already heard from some exporters who say that they are now getting bigger orders in from China because, of course, New Zealand isn't a country that is restricting that trade. So there will be ups and downs, but overall our advice is that global trade wars are bad for our economy. They make it harder for us to grow, and that's why New Zealand will continue to promote free trade on the world stage.
So will the Treasury forecast in the budget show a level of optimism that some private economists are talking about, such as Westpac this morning?
Yes, it will. The budget will show that our economy is continuing to recover from a very bad patch. That recovery will strengthen through the year and into next year. Unemployment is forecast to start coming down in the latter part of this year and to keep falling next year. That's really good news for New Zealanders because a growing economy means more job creation, it means more income growth, it means more ability for the government to support the public services we all rely on.
Given the global upheaval and how important China is for us in terms of trade, how soon would you expect the Prime Minister should be travelling to China to ensure that relationship is strong?
Well, the Prime Minister will make his own travel plans known in due course, and he has made it clear that he does intend to visit China. We value that relationship, and through a range of our ministers and diplomatic channels, we are nourishing that relationship and ensuring that channels of communication remain open. It's in New Zealanders' economic interests that we do so.
This might be a bit of
The Elevate Fund was set up in 2020 with $300 million. A lot of that capital has been deployed. The sector wanted it to be topped up to at least $300 million again, if not $500 million. There's a lot of inflation, as you like to point out. The whole point of the fund is that it provides scale for the sector. With only $100 million in it now with a top up, is that enough to provide the scale? Is it actually enough to do the job of the fund?
Yes, I think so, because when you look at the size of the individual investments that Elevate has made, they would be able to make several with this top-up of a similar size. And I think we do need to be prudent, which is to ensure that we're also putting capital into our schools, into our hospitals, into our roads and our rail system, and that's what our budget needs to balance up. But this is a very strong gesture of support from the government in New Zealand's venture capital sector. We're saying we have confidence in the growth of this sector, we're prepared to put our money where our mouth is, and we encourage others to invest.
Just on the, apologies if this sounds like a simplistic question, but the $32 million and the money beyond, where does that actually go? Does it just get delegated into government baselines, or do you have various different initiatives that you can plug it into?
It gets delegated embedded into government baselines, and the original intent of the super fund was that it would offset the growing costs of funding New Zealand superannuation. As I outlined in my speech, that cost per year will grow by billions in the next few years just alone, and of course working age people are paying tax to support that. The super fund is another way that we can support that.
And the previous government, they changed the way that we measure debt to incorporate the Superannuation Fund. Are you worried that given the fact that we're going to have to start making withdrawals from the super fund is going to actually make our debt as a proportion of GDP higher?
Look, I'm very worried by some comments that Chris Hipkins made this morning in which he implied that the super fund is somehow an offset to debt. What that implies is that a government in a tricky situation, when there's an earthquake or a major climatic event, would be prepared to liquidate the New Zealand super fund in order to meet debt repayments. And that is a fairly strong statement for Chris Hipkins to make. I don't think it's prudent. I don't think that's why the super fund was set up. I don't think that that's what New Zealanders expect. The super fund is there to ensure we can continue to fund superannuation into the future. That's why we want it to keep growing and have a stable group of assets. To imply that it can be used to offset debt elsewhere is either, again, financially ignorant or misleading.
But would you like to see the super age stay at 65?
That's our government's position.
Did you see the RNZ, I think it was last night, RNZ published a note, a research note saying that the fiscal consolidation that you're doing is quite gradual. It said that I think the last government baked in unsustainable spending into baselines, which is still there, and basically said you might even need to go faster than you're already going.
Yeah, look, I was really pleased to read that injection of reality into a debate that has, I think, departed from our fundamentals at times. I've watched the opposition claim that actually what we should be doing now is spending even more, when in fact we went on such a big spending party under Labour that New Zealand is now weighed down with a structural deficit, massive levels of debt, and we are all having to haul effort to get that back under control. Now, the government has chosen a gradual course. We stand by that because we want to ensure that social supports remain, that our frontline services can get additional funding. But to simply close our eyes and pretend that we can just keep spending more and that's going to fix things, that is wrong. And so I am pleased when economists are voices of reason and point out that ours is one of the largest structural deficits in the world, and that continuing to spend more will actually destabilise our economy and diminish the financial security of New Zealanders.
In your speech about this being about the long-term gain, do you think people have lost sight of that?
I think it's really easy in the heat of every budget and every political debate to do what's expedient right now. And, you know, we saw that under the last government when they did a cost of living payment that ended up in the pockets of dead people and French backpackers. But actually what we should be doing, I think, in every budget as responsible governments is thinking about what are we doing now and what are we doing to ensure New Zealand is better placed in the future. And we can close our eyes and pretend our long-term challenges don't exist, but they do. And I'm determined to be a finance minister in a government that is making changes that make sense for the here and now and also set us up for a better future.
Is this an austerity budget?
No, this is not. This is a budget in which we will be spending more next year and the year after and the year after than we currently are. It is a budget where, due to the financial circumstances we were left by the last government, we have had to make very careful choices. The alternative route, of course, is reckless borrowing, is excessive spending that drives inflation, is more and more debt accumulation. Now, Labour have pinned their colours to the mast and have made clear that is the approach they would take in this year's budget. I think that's irresponsible, and I think New Zealanders saw what happened in the past few years when that approach was taken. This is not the time to double down on it.
You also mentioned that there would be a KiwiSaver budget announcement that would see balances continue to grow. So why won't you rule out the idea or the question of whether the government would stop contributions?
Because I'm going to make that announcement on Budget Day. What I'm making clear today is all those New Zealanders who are excited to see their KiwiSaver balances growing, who've seen their kids use it to buy a house, who are looking forward to that nest egg in retirement, I agree with you, and I want to see those balances grow too, and the initiatives we will take in the budget will ensure they do.
So you're going to increase contributions?
I'm not going to confirm what we're doing today. There will be a series of changes, and they will be positive for New Zealanders.
Chris Bishop says Labour is outright lying when it comes to their attacks on your government when it comes to pay equity. Do you agree with them?
Absolutely. I've been really disappointed in recent days to see New Zealand lower itself to a level of political debate that I associate with other countries and not with our well-informed democracy. It is one thing to claim that there is a debate to be had about the process by which pay equity regimes are negotiated and settled. It is another thing to tell an outright lie to New Zealand workers that women's pay is being cut. That is a lie. Not only is it not happening, but actually the government is sustaining a series of previous settlements for the very workforces that Labour is talking about, for nurses, for social workers, for others, who we're ensuring will continue to have the baked-in pay increases that they received as part of past settlements. And so to say that we are cutting women's pay is a lie, and I do not think that that sort of hyperbole has a place in New Zealand's political debate. Yes, it is a lie, Mikey. No, that's not. That is incorrect, because actually what we have done is the previous government, in secret, had forecast potential costs of potential future settlements, claims that had not yet been proven. What we could see was a number of those claims were becoming very bogged down in the negotiating process because of a lack of clarity about the basis on which they would be settled. We've now made that process very clear. We expect there will be future settlements, that pay equity settlements will drive future pay increases, and there will be a number of ways in which pay increases under this government, and I want to emphasise this. Pay increases not just because of pay equity. Pay increases through other collective bargaining. Pay increases and after-tax pay increases because tax rates are lower. Pay increases when an economy is growing. We are making all the decisions as a government to ensure that New Zealand workers will continue to see their wages grow.
Did you receive any advice in terms of pay equity on potential impacts to future tax takes by the government or additional, say, welfare spending, things like that, that could also be an impact or an effect of this decision?
Look, I've received a range of advice, but all advice is done in the context of the budget as a whole, because as you'll appreciate, there are a number of initiatives which we are taking, which all have different dynamic effects on the economy as a whole. The advice I have received is that overall the New Zealand economy is set to grow very well as a result of the initiatives that we are taking, and that there are specific initiatives in our budget which will support future productivity and future wage growth.
And had Cabinet signed off previously a budget or a general policy on this budget prior to the pay equity policy or legislation being added to that? Did you have a previous draft without this law change?
So in April last year, Cabinet signed off on a series of decisions relating to pay equity. In December last year, the Cabinet Strategy Committee discussed the direction we wished to take on pay equity. Policy papers were taken to Cabinet in March. So throughout the months in which we've been discussing the budget, we were aware that there were outstanding decisions on pay equity and therefore how much we would be forecasting for the cost of future claims, and that was factored into our budget discussions.
Cool. Can the Minister go and be polite to the people who are here now?
Great. Okay, thank you for your questions.